In this video, we will understand what is put option and how we can use the put option in our trading. I don't want to go into the standard definition of the put option because that is of no use. Basically, we buy the put option when our assumption about the market or a particular stock is bearish. That means like if the particular stock or a market is about to go down, if you buy a put option, you will get a benefit from it. Okay. To understand the real purpose of the put option, we will take a real-time example. We will understand how we can use the put option in our trading. Let's take an example of car insurance. For example, you own a car, so you want the insurance for that particular car. So what you will do, you will buy an insurance. To buy an insurance, what you have to do, you have to pay some premium. For example, we will pay 10,000 to buy the insurance for our car. The insurance cover is up to 5 lakhs. If I pay 10,000 per annum, our insurance cover will be up to 5 lakhs. So this insurance comes with a expiry. So insurance they give, right? It is not infinite. Insurance will be valid for 1 year. After that, you have to renew it or else your insurance will expire. Let's assume that after buying insurance, your car met with an accident. So what will happen? The insurance company, right? They provide the cover for your damage. Similarly, so the put option is there, right? If you buy a put option for your portfolio, then it will provide the cover for your portfolio. For example, you invested 10 lakhs in Infosys share. If Infosys shares goes down, what will happen? You will incur a loss. So how much loss you incur, that depends on how much the market goes down. To prevent our portfolio or investment from going into the loss, what we can do is that you can buy a insurance. That insurance is a put. Okay. If you buy a put in Infosys, what it will do is that it will act as an insurance for your investment. Similarly, for the car, we bought an insurance by giving some premium, right? Similarly, if you buy a put option by giving some amount, okay, it will act as an insurance for your investments. Now we understand the purpose of the put option. Now what we will do is that we will go to a particular stocks and we will buy a put option and we will see how it works. In this example, we are buying a put option in Infosys. Infosys is currently trading around 1,500. So what we will do is that we will buy a put option at the strike price is 1,500 only. Okay. So if in case Infosys goes down, our put option is there, right? It will come to our rescue. It acts as an insurance. Here there are two important things. The first thing is that we have to pay some premium to buy the insurance. Here you can see we paid 8,000 to buy this particular insurance. How long this insurance is valid? Here you can see the expiry 27th June. Okay. The insurance we bought, right? It will provide the cover till 27th June. After that, this insurance, right? It will expire. There are a few things over here we need to understand. If you want to buy the insurance, someone has to sell it, right? So they are called as the option sellers. Someone who's buying the insurance is called as an option buyer. So in our case, we are the buyers. They are the insurance provider. For that, what we did is that we given some premium. In our car example, if the accident happens, what will happen? The insurance is covered by the insurance company. Similarly, if the market goes down, the option seller who sold the options, right, they have to provide the insurance cover for the option buyers. Here one important point, that is called as a break even. What is this break even? Here you can see the break even is 1480, 1480. How do you calculate this break even? And before that, what is the break even means? Break even means that if the market on 27 June expire at this point, that is 1480, that time you won't lose any money. So whatever the premium you paid, right, 8,000, you will get back the same amount. So that time you neither lose nor gain. Okay. If the market goes below 1480, so then what will happen? You will get benefited from the put option which we bought. If the market expires above 1,480, then the whatever the premium we paid, right, in that we will incur a loss. For example, if it expires above 1,500, then whatever the premium we paid, right, that is pocketed by the option sellers. Similar to the car insurance, okay, we paid some premium, car doesn't met with any accident, then what will happen? The car insurance keep the insurance money. You guys might be wondering, I don't own any particular stock, still I can buy a put option. Of course, you can buy a put option. That time you are speculatively trading. You are not hedging your portfolio. Okay. So depending upon the market, either you can make a money or you can lose the money. Let us summarize the things what we learned so far. We buy put option when our assumption is bearish. That means our assumption is that market might go down. The put acts as an insurance to our investment. If you buy a put option, right, so that provides the insurance cover to our investment. You can buy an option without having any investment also. That is called as a speculative trading. If it goes in favor of you, you will make a profit. If it goes against you, then you will make a loss. I hope you enjoyed this video. Thanks for watching.